Novo Nordisk stock has fallen dramatically, but the underlying business is still growing. Revenue continues to rise. Analysts expect that growth to continue, and three separate indicators are now showing conditions that have historically appeared near major bottoms. The first signal has appeared only 6 times since 1988. Each time, Novo Nordisk eventually moved higher, with gains ranging from 40% to more than 700%. The second indicator recently crossed a level that has historically confirmed the end of major declines. And the third shows that Novo Nordisk recently traded at one of its lowest earnings valuations in almost 4 decades. So, is Novo Nordisk simply cheap, or is the bottom already behind us? Let's look at the data. The first indicator is revenue momentum oscillator. This compares the movement of Novo Nordisk stock price with the underlying movement of its revenue. When the indicator moves deeply into the green area, it means the stock price is significantly lagging the company revenue performance. That is exactly what is happening today. Since 1988, Novo Nordisk has entered similar conditions only 6 times. After the first signal, the stock gained approximately 700% over the following 10 years. The next two signals were each followed by gains of around 40% over approximately 1.5 years. Another was followed by a 65% gain over 2 years. The final two preceded gains of roughly 330% and 220% over 7 and 7.5 years. The size and timing of these moves varied significantly, so this indicator does not mean Novo Nordisk will immediately rise 200% or 700%. But the historical direction has been remarkably consistent. Every one of these conditions was eventually followed by a meaningful positive price performance. The signal is now appearing again. When we zoom into the recent period, we can see exactly what is creating the signal. Novo Nordisk's revenue has continued to grow while its stock price has fallen sharply. The market is valuing the company lower even though the business is producing more revenue. Now, this does not automatically mean the market is wrong. Investors may be worried about competition, pricing pressure, margins, or slower future growth, but this divergence cannot continue forever. Eventually, either revenue growth must stop to justify the lower price, or the stock price must begin recovering toward the company's fundamentals. Current analyst estimates still project revenue growth over the coming years. Analyst estimates are not guarantees, but they suggest that the market is pricing in considerably more weakness than analysts currently expect. That brings us to the indicator that may show whether the stock has already started forming a bottom. This chart compares Novo Nordisk price to sales ratio with its own 2 years average. When the indicator falls below -1, it means the stock is trading at an unusually low price to sales valuation compared with the previous 2 years. But the most useful signal is not simply the move below the -1. A stock can remain undervalued for months or even years. The stronger historical signal occurred when the indicator recovered back above -1 after spending time below it. Every single time this happened historically, The recovery above -1 indicated that the bottom was already in. Instead, it began a sustained move higher. Recently, after remaining below -1 for an extended period, the indicator crossed back above that threshold. It is now sitting at approximately -0.9. That may appear to be small change, but historically the direction of the crossing mattered more than the exact reading. Novo Nordisk first became unusually cheap relative to its sales. Now the valuation is beginning to recover. Historically, that combination indicated that selling pressure was fading and the market had started repricing the stock higher. It does not mean the stock will rise in a straight line. There may still be volatility and pullbacks. But based on this indicator, the historical evidence suggests that the bottom may already have formed. The final indicator is Novo Nordisk's trailing 12-month P/E ratio. Novo Nordisk's P/E ratio recently fell to approximately 10. That is extremely unusual valuation for this company. The last time Novo Nordisk reached a similar level was around 2003, which marked an important long-term bottom. Before that, the stock traded near or below this valuation during 1988 and 1989, and briefly returned to the same area in 1990. So this is not simply cheap compared with the last few years. Novo Nordisk recently traded at a valuation seen only during a handful of extreme periods over almost 4 decades. A low P/E alone does not guarantee that a stock is undervalued. Earnings can decline, and cheap stocks can always become cheaper. But this low P/E is not appearing by itself. Revenue is still growing. The revenue momentum oscillator shows the price is significantly lagging the business, and the price to sales indicator has crossed back above a level that historically confirmed major bottoms. Based on this data, I believe there is a strong possibility that Novo Nordisk's bottom is already behind us. The main risks would be a significant slowdown in revenue, lower future estimates, or the price to sales indicator falling decisively back below -1. But unless the fundamentals get worse, Novo Nordisk currently appears unusually undervalued relative to its own history. The question may no longer be whether Novo Nordisk is cheap. It may be how long the market can continue ignoring the divergence. If you found this analysis useful, please like the video and subscribe for more data-driven stock analysis. Also, let me know in the comments whether you think Novo Nordisk has already bottomed.